Yeah, it's a really weak correlation. It came about back when labor was more domestic in general, right? Less globally interconnected. And the general idea is that if the economy is running too hot, they can tighten money, they can raise rates to try to make it run a little cooler. On the other hand, if it's running too slow, they can loosen money and try to get more people back to work. And of course, there's been major decades of stagflation. We have high unemployment and high inflation. If you kind of map out the long-term relationship between unemployment and interest rates, it's a very weak correlation overall. And yet the entire institution of the Fed is basically based on this relationship being extremely tight, right? Their mandates are, basically price stability, which they currently define as 2% average inflation per year, the way they measure it, and optimizing long-term employment. And so they kind of inherently have this relationship built into their DNA. And so it's kind of like, they're operating on a certain algorithm that might or might not be applicable, and more often than not is not particularly applicable. But that's kind of what they have to do legally, and so it's kind of it's an interesting system, and it's I think we're at the phase of the long-term debt situation, the long-term fiscal situation, where interest rates and overall monetary policy are going to be increasingly politicized. The last time government debt as a percentage of GDP was this high was at the 1940s, and the Fed was essentially captured by the Treasury. Basically, they had to make interest rates, at a level that was, in line with how much debt and spending were happening at the public level. They had to keep them low despite high inflation. And now, of course, we have a different degree of central bank independence, but I think that's going to be increasingly challenged. And there's the two interesting sides of that are, one, I think some of the challenges are appropriate in the sense that you can say, does your model even make sense, right? So they can ask Powell, like, does your focus on creating more unemployment, is that actually going to bring down inflation? On the other hand, on the public sector side, a lot of the inflation we're seeing is fiscal driven inflation. And so there, in many ways, is that, their decisions over decades have contributed to this. It's part of the underlying money creation mechanism. And, so they're kind of facing their own problems. And so I think that's going to be a whole thing this decade.
Bitcoin price is up on March 11th as cryptocurrency markets stabilize following panic over a potential banking crisis. Hello and welcome to Crypto Street. In today's video, Lyn Alden updates about her outlook for Bitcoin in 2023. She also breaks down the importance of regulatory clarity in the space and how it will drive the future of institutional adoption in crypto.
So I think, yeah, we definitely have to analyze the path dependence here. So for one, I do agree that CPI has historically understated actual inflation. Basically, and one of the biggest components is how they redefine shelter. There's also challenges, obviously, with hedonic adjustments. One of the things I like to do in history is look at a handful of things that just don't change, like beef, gold, bacon, oil, a barrel of oil, and look at the price of those over a very long period of time. And some of those are obviously very volatile in a 10-year period because you have, obviously big supply comes online, and then there's periods where there's not enough supply. But if you look at them over the course of like a 50-year period, most of those things have gone up faster than the CPI, because CPI, you're constantly adjusting towards cheaper things, and you're factoring out some of the appreciation in real estate because they're using owner's equivalent rent instead of housing. There are brief periods where CPI could ironically overstate inflation. Like if you have house prices stagnate for a while and their shelter component is like operating on a lag because it's kind of this like janky calculation. You can have this like brief window where like CPI is actually, overstating inflation because real inflation is more volatile than their calculation will get to, but the majority of the time, I think it's generally going to understate it. As for basically the path dependence here, my base case early last year was that they were going to tighten into a recession. They would probably get the inflation down, and then because the underlying problems are unresolved, when they try to loosen, when they try to have another growth phase, that inflation is going to come right back, right? Until you basically fix, the combination of structural fiscal deficits and fix the energy supply and transportation problem globally, As long as those two pieces are there, inflation is ready to bounce back whenever there's a period of growth. And so that was the base case. We're starting to see early signs that they might not even be able to get, inflation down as much as they wanted before the next cycle of inflation. I'm not quite there yet in terms of saying that they can't. I still think they have a window here where they can cause so much private sector damage that they might be able to temporarily get inflation down. But I think the main problem is that it's just ready to go. It's ready to come right back as soon as they have another growth cycle, as soon as they let their foot off the brake for a brief period of time. And basically, they're using 1970s monetary policy to fight 1940s style fiscal driven inflation. So, if you look at over time, the inflationary decades that we've had in the United States and elsewhere have had very different reasons for why that inflation exists, right? So the 1940s, banks weren't lending much, but instead the government was running absolutely massive monetized deficits, and that was the source of money creation and prices going structurally higher. In the 70s, you did have deficits, but they were much smaller, and that was the peak period for bank lending. So basically, the credit multiples constantly going up. Banks were lending aggressively. You had baby boomers were entering their home buying years. Then you combine that with oil shortages. So you had both supply side constraints and you had tons and tons of bank driven money creation. And so back then, one of the main tools they used was trying to slow down that bank money creation with tighter monetary policy. That's basically the Volcker playbook. They also did a bunch of geopolitical things. I mean, they went after unions to try to get domestic labor from going up like it was. They tried to open up global trade. So they did a lot of other things in addition to monetary policy, but basically that tight monetary policy made sense in an era where banks were doing most of the money creation. Whereas in the 1940s or the 2020s, when most of the money creation is fiscal deficit spending, when you raise rates, it doesn't really change what the government's going to do. I mean, they're going to spend what they're going to spend, and now they're just actually pouring even more money into the economy with their deficits because they're paying such high interest rates on them. And so it's kind of interesting to see them do the 1970s playbook for a 1940s problem. And in my mind, it just shows that even if they temporarily get inflation down, they don't fully understand the nature of the problem. And so it's ready to come right back.
After threatening to lose $20,000 as support, bulls are attempting to preserve some significant trend lines as weekend trading offers a chance for increased volatility. Uncertainty remains in the air, however, as the aftermath of the meltdown at SVB Financial is far from over. Crypto stablecoins in particular are feeling the heat. How is Bitcoin recovering, and how does the short-term BTC price outlook shape up for traders?
When you look at public concerns around the debt, they peaked in the late 80s and the early 90s, right? So if you look at interest expense over time, it was going parabolic in like the 70s and the 80s. And in the late 80s and the early 90s, it reached a peak as a percentage of GDP. And that's because you had rising deficits and you had high interest on those deficits. And that's, for example, the famous national debt clock was installed in the late 80s. Also in the early 90s, you had the most successful third-party candidate in American presidential history, Ross Perot, and he a big thing he ran on was the debt. That was like a big theme that was like really, it got the public attention at that time. And a lot of that was kind of like 3 decades early, because what generally happened over the next couple decades was you had this, rapid period of globalization, lower inflation, lower interest rates. And so even though debt as a percentage of GDP kept going up, the interest expense kind of stagnated, especially relative to the size of the economy. And it went down for a period of time. And so you had basically 4 decades of rising debt as a percentage of GDP and 4 decades of falling interest rates offsetting that. And now we're in like the awkward part of the cycle where debt as a percentage of GDP is still going up, but those interest expenses are not going down anymore and might start trending higher. Certainly in the near term, they're trending higher. And so that's when you actually revisit those concerns of the late 80s and the early 90s and say, okay, basically they were early, but now we're actually getting to the phase where some of the things they're worried about are more structurally occurring now, and there's a lot less wiggle room to deal with them.
So what are your thoughts about lyn Alden's prediction? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.